most countries, or basically, all countries cannot get out of the situation without some form of financial repression. The money itself is devaluing actively. They start to buy gold, they start to buy Bitcoin, they start to buy silver, institutional capital and personal capital into hard assets. China is essentially doing this, like you could say 10, 20-year chess endgame of slowly divesting from the dollar, but not in a way that would immediately cause a dollar crisis, but is rather causing fiscal crisis. China right now controls 70% of global refining capacity. They hold about 85% of global solar manufacturing capacity, 98% of wafers, 90% of cell production, of solar cell production. And they also produce the largest amount of silver in the world.
For something like Bitcoin, in my opinion, is very, very bullish. And I look at Bitcoin at, $60-something thousand. I'm like, this is super mispriced, just personally.
Okay, a millionaire. I'm a young money millionaire.
Okay, good morning, good afternoon, good evening, everyone, and welcome to the Thursday edition of the Daily Stack. Bitcoin is back down in the 60s after a pretty substantial rally. I think it was 10 or 12% from trough to peak about a week and a half ago after everything came tumbling down. Hedge funds were collapsing. Bitcoin is now sitting back in the 65, 60, 66K range. And we are about to dive in with two macro experts, Peruvian Bull, aka Roberto, and Infranomics, Robert. So yeah, let's take on let's tackle the first topic. But before we do, anyone who's listening on any of the social media channels, on YouTube, if you're on X, please give us a like, reshare the stream, tell anyone and everyone about us. We have some awesome alpha that we're about to drop into for the next hour. Following that, we have another two guests at 1:30 Eastern time. So we have a ton of content to get through, all to keep you updated on what's going on in the macro and Bitcoin world. So let's start off with you, Infra. What are you looking at?
Saw a low here, 59. Now I could 100% be wrong, and we can break lower than that. It's not a high conviction bet, but if we go lower, I'll just buy more. We were kind of in this downtrend here. We got a very capitulatory sort of price action where we went parabolic to the downside, and you had a huge spike in volume as well that kind of corresponded with that waterfall price action. We got super oversold on like the daily and kind of some of the longer time frames, starting to get into that oversold RSI territory. Everything just kind of lined up for me that I think that it was probably the low. Momentum is getting kind of hammered again today, software and Mag 7 and tech. So Bitcoin being so kind of high beta, if the broader market, if the S&P 500, the Qs are weak over the next couple weeks, Bitcoin will probably go lower. So ultimately, I think it probably comes down to your bet, your call on the Qs, and those sort of sectors. What do you think quantum stocks and ARKK and that kind of thing? What do you think those are going to do? That'll probably help inform where you think Bitcoin might go.
Yeah, Peruvian. What's your take on where we're headed next? I mean, it feels there's a lot of anecdotal evidence, at least in my personal life, that I've come across, like gym trainers that I've spoken with who have decided to sell or capitulate, sell their XRP. Whether or not that was the right bet in the first place is to be debated. But regardless, I got a lot of anecdotal firsthand evidence that people are very anti-Bitcoin and anti-crypto at the moment.
Yeah, no, absolutely. I listened to a recent podcast on TFTC with James Check or Checkmatey, and he was pointing out that at the lows we were sitting at a spot where only 4% of all trading days in Bitcoin had a lower percent below the 200-day moving average, and that was as of late January, early February. And so I think we've hit a temporary low a bottom in the bear market. And I think we're going to trade a little higher in this range for the time being. That being said, I agree with you. Sentiment on Twitter is really, really bad. Actually, I was messing around with Claude and building these kind of like Claude Python projects. And I built one to assess Twitter analysis. And it said that it was the lowest Bitcoin sentiment that it's ever seen. And again, it's only been running for about like 2 weeks, 3 weeks. But even in that time frame, right, earlier, Bitcoin was in the 80K range and the sentiment wasn't great. So clearly, I think overall view of Bitcoin in the macro space is pretty negative, and I think a lot of especially traders and short-term momentum guys have been selling. But for the long-term hodlers, I think this is a buy the dip moment, right? If you believe that the fundamental story hasn't changed, the fiscal trajectory of the United States hasn't changed, the potential rate path of the Fed lowering back to 0.75% or so isn't going to change, then the fundamental value of Bitcoin isn't any different. It's just the temporary, sticker price that you see on TradingView.
Yeah, I totally agree with that. Like, we there was a lot of talk about fiscal dominance, over the past couple quarters or year or two. That didn't just go away. Interest expense is still growing at 15% year over year, $3 billion per day, 23% of tax receipts. They have to cut the overnight rate because that's the only way to get lower to refi or roll debt at a lower rate than the current outstanding debt, which is currently 3.3. They have to cut. It'll be negative real rates. It'll be in T-bills, which is very like dollar negative, very inflationary. All that stuff, like nothing changed. Kevin Warsh, in my opinion, anyone that thinks he's going to shrink the balance sheet to $3.5 trillion, like I don't get it. I don't see how it can be done. We saw what happened to the repo market when bank reserves got much lower than they are now. That's why they started RMPs, Fed money printing to buy T-bills. Like you can't shrink the balance sheet really at all from here. TGA, right, has to be up around 900 billion or so, because every 5 days we have $650 billion of T-bill redemption. So there's got to be a buffer, a couple day buffer. Well, we're rolling so many T-bills, the TGA has got to be high. Bank reserves can't decline because the basis trade is financed in the repo market, and the basis trade has bought about half of all the new U.S. treasuries that have been issued over the past 3-4 years. So like you just look at the incentives, none of those things change, whether it be, fiscal dominance, what's going on with the deficit, what's going on with interest rate policy. It needs to be lower because the long end is definitely not cooperating. So they got to get front end rates down and issue all their debt in T-bills, which again, like they can do this, but for something like Bitcoin, in my opinion, is very, very bullish. And so I see that kind of longer, 2, 3, 4 year sort of view. And I look at Bitcoin at, 60 something $1,000. I'm like, this is super mispriced, just personally.
No, totally.
So I think,
go ahead.
Sorry, but before we get into kind of the mispricing, because I think this is important and it's missed by a lot of people, is a lot of people assume that, hey, they have to cut, right? And we have to get additional stimulus. I wonder if the QQQs, NASDAQ, all quote unquote risk on assets were trading as if that was an already built in pre-assumption, and that the new world that we're living in isn't necessarily flat, that they're going to not print rates or that they're not going to cut rates, but more so that we're going to hold steady for longer, in which case that's what's driven the recent sell-off. Is that an accurate take? I mean, as opposed to just assuming the assumption that they would continue to, provide stimulus ad infinitum.
You want to go first? Go first.
Yeah, I don't think that they're going to hold rates right now. Like if you look at what's being priced in, about 2 cuts. And yeah, I think that look, with the Fed funds at about 350 right now, that would get you down to 3%. Well, that would be 25 bips lower than the average interest rate on the marketable debt outstanding. So you, at that level with 2 cuts, you would stop the increase in terms of interest expense. You wouldn't really start to like make any progress in the other direction, but you would at least stop it from growing, because as interest grows right now, about $1.2 trillion per year, as that is growing at a 15% year-over-year growth rate, and we're refining more and more of our debt at higher and higher rates, it gets away from you very quickly. So that would at least arrest the growth in interest. Then I think further cuts could help to get interest to actually move in the positive direction. But it's all very inflationary. Inflation's already at 3%. You already have gold screaming higher, assets, equities basically at all-time highs, home prices all-time highs. So you already kind of have inflation closer to 3, assets at all-time highs, and you're looking at like more cuts like this. I don't see how it's not bullish for Bitcoin.
Yeah, I would second that. And you've got to consider that, not only has the Fed committed already to buying $40 billion a month in these, not QE program, that they claim that they're going to reduce obviously in the future after tax day. But they've also been making moves to increase liquidity, not in the traditional sense, but by using almost like what I would call stealth QE or stealth stimulative measures. So one example is back in November of 2025, quietly, the CFTC and the Fed in conjunction lowered the SLR, the ESLR for GSIBs from 3% to 1%. And what that does essentially is allows banks to buy treasuries and hold less capital against them in case of losses. And that might sound technical, but functionally what it means is that a bank can hold more treasury debt on their balance sheet without having to tie up capital to shore against it. And therefore, that capital can flow more easily into the financial system, into the banking system. It can be used for other collateral. It can be used to buy or sell securities. And so that allows the banks to buy more debt as a percent of their balance sheet. And that action essentially is allowing banks to act almost as like quasi-intermediaries of the Fed, in that they can absorb excess treasury market issuance without the Fed actually coming out and saying we're doing full bore QE again. And I think it's also important to note, right, like this 40 billion a month in RMPs in this, not Treasury QE or not QE, but QE program it's not nothing, right? The QE program of 2021, which we called QE4 or QE Infinity, which was the largest yet, was 120 billion a month. And so this is about a third of that size. And this is ostensibly happening with, the US not fighting a major war, no major banking crisis, no major recession. There isn't a really verifiable reason that I can see for them to do this other than just the liquidity side of things. Obviously, what Powell was mentioning in his press conferences was the tax strains on, mid-April that are coming up. He was worried that there wouldn't be enough liquidity in the system and reserves to buffer, tax withdrawals from corporations and, having that money flow into the TGA. But I don't think that has ever been used as an excuse before to do a program like this. And so the fact that they're doing it now shows me that they're worried about the liquidity side of things, and they will do obviously what it takes in order to ensure that adequate reserves are in the banking system.
Yeah, and they're going to err on the side of caution, in my opinion. I get Kevin Warsh has made some hawkish comments in the past, but number one, people change. And if you look at his opinions, they change based on the party that's in power. There's a chart I think Bloomberg put out that shows he's very partisan. People change, opinions change. The landscape, the data changes. We're entering kind of this crazy brave new world of like sky high productivity that, you're already hearing them lay the groundwork for further rate cuts beyond kind of what they had assumed neutral would be, even beyond neutral, because they're like, oh, well, look, productivity is sky high. So the economic potential of the US, is so much higher. We can cut even beyond neutral and not have inflation. Now, in my opinion, it's all BS. It's related to the interest expense and the deficit and fiscal dominance. But look, like if that's the political cover that the facade that they're trying to create. You hear people like Zervos also kind of talking about it. I think that's probably what we're going to hear a lot more of as the year drags on, and we see kind of AI productivity continue to trickle in. Q2 was really high. Every revision was higher than expected.
Sorry, can we jump into that just in terms of some of the graphs to see exactly what you mean by like higher than expected? Because curious as to what you're tracking on those measurement tools.
Yeah, productivity and for example, GDP, there are multiple revisions that come out. And so each of those releases in Q2, and I'm pretty sure in Q3 as well, each of those releases, the market expectation going into the revision was lower than the productivity number actually came in. So it's not like most of the other economic data gets revised, and with things like GDP and productivity, it's revised multiple times. But Q2 was hot. It was 3.3%. That was the final rate for Q2 productivity. Q3 came in even higher. And we're probably likely to see that trend continue, which raises some interesting questions about what happens to the unemployment rate, and what happens to, like, if the average American is not benefiting from all this productivity, then kind of ultimately, it goes back to my now viral chart of S&P 500 relative to job openings. We're gonna maybe not this year, but within the next couple years, we're probably going to need to have some conversations about UBI and how do you fund the UBI, all those kind of things, because productivity I don't think is going to slow down.
Agreed. Yeah. I think there's obviously anecdotal evidence of this softness. There's the Amazon announcing layoffs in Seattle, which is where I live. I think around 10,000 SWEs, software engineers, were laid off. A couple other big tech companies have also announced plans to continue to reduce headcount, given the boom in production that they're getting from, and productivity that they're getting from AI. But the last non-farm payrolls, printed 130,000 increase, which was way above the consensus estimate of 50 to 70,000. So there is still obviously some fundamental growth, but I think that we're going to see a sector rotation. Sectors like healthcare or plumbing, electrician, right, the trades, we can still see fundamental job growth there, but especially software engineering, clergy work, any sort of clerical functions, administrative work, all of that is increasingly automatable by these models. And Claude especially is insanely good. And with the release of Opus 4.6, which happened earlier in February, all these models have just gotten like leaps and bounds better. I myself, like I said, I've built 2 or 3 tools just in the last few weeks as a non-developer, using Claude Code and Claude Bot. And if I can do it, anyone who has any sort of tech experience or tech knowledge could be building essentially their own startup with just like 1 or 2 people.
Yeah, here's a chart that I saw earlier today that's pretty wild. So within healthcare, which is basically once you remove healthcare, job growth over the past decade has been pretty poor. But what even within healthcare, so this chart shows the individual and family services. This is the change in non-farm payrolls since April of 2025, Liberation Day. That's grown by 169,000, and that industry group comprises establishments primarily engaged in providing non-residential social assistance to children and youth, the elderly, people with disabilities, and all other individuals and families. So we have an economy increasingly where the jobs are healthcare. It's taking care of old people, maybe taking care of depressed Zoomers that are giving up on the world, right? Like what how healthy is an economy where so basically the sole job creation is in healthcare. And so, yeah, I think, when you look at productivity, it kind of makes sense, right? Like manufacturing, for example. Well, if you can automate within manufacturing due to, mechanical developments and automation with robotics, manufacturing employment's going to probably not do too well. And if you look at the ISMs, that's sure enough exactly what we see with ISM manufacturing. The employment index has been in contraction, arguably going back to 2021. So, healthcare, it's kind of hard to automate. And I think that, part of what we're seeing today, like the productivity gain, the productivity boom has already kind of started, and we were already seeing the effects of it kind of even before this year, 2025. You can look at job growth by sector going back to like 2018, 2019, and it's really kind of all just been healthcare, which it's like, well, how healthy is the economy really? It's certainly not jobs in manufacturing. Now we need to bring back industrial capacity for defense, for national security purposes. But like in terms of, bringing back those good paying blue collar jobs, because you said something that I think is really important for people to understand. Right now, we're talking about automation of white collar jobs, but blue collar jobs have been under pressure for decades. And, the establishment, the elite told them, learn to code. Well, how is it going to be different when it's a bunch of white collar jobs that are being lost, right? Like, how is that going to go? And I think, maybe I'm cynical, but I feel like, when the white collar jobs, when those people start losing their job, I think it's going to politically, you're going to see a stronger reaction than you would have, or that we did back when it was blue collar jobs. Because moving numbers around on a spreadsheet, some email job, that's very easily automatable. And again, we've kind of already seen the productivity boom start to have an effect on the labor market by sector. And at the end of the day, like within 5 years is my bet, we're going to have a question about UBI. And how do you fund that UBI? Well, the only way I kind of can come to is to tax the very Mag 7 companies propping everything up. And so then that raises the question, okay, well, if you're taxing, Google, Meta, some huge windfall tax, how does that, what effect does that have on the stock market? Well, everyone's giga levered to the stock market these days. What happened, right? And was that due to tax receipts when capital gains tax plummets, right? Because the stock market's plummeting, stock-based compensation, right? Like all the hyper financialization consequences. It's gonna cause some problems, like at the end of the day, productivity is productivity, deflation is deflation. But Luke Groman always points out, before it was globalization. But what happens when it's AI, the white collar guy with a $90,000 car note, he's still got to pay a $90,000 car note. He's still got a mortgage. He's still got grocery bills, regardless of if it's coming via AI or it's coming from some other deflationary force. The end result, kind of in a macroeconomic sense, arguably is really no different.
Well, sorry, then the irony would actually point to UBI being bullish for Bitcoin if it continues to track like that basket of software stocks, right? I mean, you could make that argument for in 3 to 5 years' time, if there is that quote unquote stimulatory UBI check on a consistent basis. I mean, surely if we're levered to a lot of those stocks, that's something that would benefit Bitcoin.
I think so. I mean, I'm very bullish Bitcoin for the next decade, 2 decades, medium to long term time horizon. I think that, depending on how there might come a point, right, in the next 10, 20, 30 years, and there might come a point that the smart decision is to actually sell Bitcoin. I know it's heresy. I don't think that that's likely, but it is a potential, kind of option on the horizon that we go into some, very long deflationary sort of, lost decades like Japan. Right, sort of thing. And generally, you don't want to own risk assets during that sort of environment, but they have to de-lever the debt first. You can't go into a recession with the leverage on the sovereign balance sheet being what it is. On average, over the past couple of recessions, the deficit widens by 600, 700, 800 basis points as a share of GDP. That takes our deficit to like almost 15% of GDP. That is a huge amount of bond supply into a relatively constrained balance sheet capacity. You could very well have bond yields going up in that environment. And that's not just me that's been saying that. Jeffrey Goonlock is now saying that, the bond king. So yeah, like I think they got to de-lever the debt. And I think to what we were talking about with interest rates, I think that's going to be how they do it. They're going to cut interest rates at the front end, issue all the debt and T-bills, and financially repress T-bill holders. And guess what? Oh, here's some stablecoin legislation to, stablecoins being buyers of T-bills. It's all there. They're trying to open up and tap financially repressible balance sheet. And stablecoins offer some. I don't think it's going to be nearly as much as the bullish estimates. I think it'll be a couple $100 billion, but that's still something, right? Because after World War II, that's what they did, yield curve control. And we're going to financially repress you at negative 15, 16% year over year. So if you bought bonds, you were guaranteed to lose 15, 16% to inflation. And it was kind of like, it is what it is. We had capital controls back then. The U.S. back then was quite different. But the story kind of never really changes. History rhymes, it doesn't repeat. And I think they're going to do it with T-bills, and they're going to try to find stablecoin that'll open up some demand to financially repress. That'll be how they de-lever. Once we get debt to GDP down to, 50, 60%, it's a totally different situation, going into recession. But they have to de-lever, because if we go into a recession, if we go into an economic contraction, you play, all you have to do is kind of think that through a couple steps, and you come to the conclusion, well, then they would just have to print even more, than say 2008 or even 2020.
Mm-hmm.
I guess then the logical question is, are there examples of countries reducing their debt in the past? Has it been done? Because, if outside of Japan, I'm not aware of many civilizations, economies, countries, whatever you want to name, that have been able to successfully de-lever over time.
You just run negative real rates.
Yeah. Yeah, Heisenberg Research did a study back in, I think it was 2019, and they found that since 1850, there had been 55 economies who had gone above 120% debt to GDP, and 54 of those 55 economies had defaulted either by financial repression, hyperinflation, complete remonetization of the currency. So, for example, like in Peru, they went from the old Peruvian sol to what's called the nueva sol. So they just remonetized and just said, okay, we're getting rid of the old currency, we're creating a new currency, and everyone has to use our new one. Or outright cutting off, zeros on their currency and trying to rejigger the monetary system that way. The only exception to that was Japan. And Japan is currently in the midst of their own currency crisis that is obviously taking years to play out, but is essentially what I would call like a slow-moving train crash, where every move that they make to try to remedy the situation, whether it be interventions, whether it be moving the bands on yield curve control, whether it be eliminating yield curve control and then starting to hike rates, whatever they do, it just seems to make the problem even worse, as we can tell from recent moves in the Japanese bond markets and obviously their currency markets. Overall, most countries, or basically, all countries, cannot get out of the situation without some form of financial repression. And again, the most common way to do this, and I wouldn't say most painless, but you could say most extended way to do this in terms of moving the pain out over years instead of just focusing it on a single currency devaluation, is financial repression, right? It's just simply lowering rates, real rates, until they're deep into the negative territory and holding them there for years, so that savers of capital, so that investors who earn below that hurdle rate are essentially bled dry, and the state is able to, resettle their balance sheet, unlever their balance sheet in order to be able to have more flexibility going forward in the future. It's like Infra said, it's what the US did in the 1950s. It's what basically most major economies have been doing after every single major crisis, after every fourth turning, right? After any war, the UK, France, Germany, most of these countries, after a major event where they're massively fiscally irresponsible, where they're massive, debtors, where they're taking on new credit, they have to remedy that somehow. And again, in the pre-gold or pre-fiat era and the gold standard, they were doing that by just simply revaluing the currency. So you'd say, okay, the German mark is no longer worth, 1 gram of gold, four marks is no longer worth 1 gram of gold. It's now 10 marks to get you 1 gram of gold. And they just simply make an edict like that, and it would go out to all the traders, and then the market prices would adjust. But now, obviously, we live in a different world, and the financial repression is just a much easier way, because most of the population, unless it gets bad, won't know. They won't realize what's happening until it's too late, until their savings are depleting, and they're asking questions like, why can't I pay for my groceries? Why are my interest payments so high? Why can't I afford anything? That's just the way that most of these sovereigns go about this.
So you would essentially then be, one way to word it is you're penalizing savers. Another way to look at it is you're incentivizing individuals and or corporations to take out as much long-dated debt as possible, right?
Yeah,
Absolutely.
the goal is to make money cheaper.
Mm-hmm. Exactly. But the problem is when you do that too much, you can run into a liquidity trap where, banks can be lending out debt. Corporates, individuals can be taking out that debt and trying to use it. But if there's no good source of actual economic growth and source of fundamental returns, there's nowhere to put it. And so you start to run into the situation that Japan had in the late 1990s, where you lower rates, nothing happens. You lower rates even more, nothing happens. You go to zero, nothing happens. You go to negative, nothing happens. March 2001, you start QE, no one wants to spend, because you're in a situation where you've essentially gutted economic growth so deeply that there is no fundamental investment case anymore for your money. It's just simply a savings vehicle. And in an environment where there's no inflation, you can kind of continue and kind of kick the can down the road as long as you can with that model. However, obviously, this starts to break down once you have a bout of inflation like Japan is seeing, or like a lot of other major economies are seeing right now. Because then not only are you having a economic growth problem where you're creating too much credit in comparison to how much viable economically positive projects there are, but you're also having a situation where the money itself is devaluing actively, and the individual saver, the individual corporate, without any positive IRR investments to make, they have to just simply hedge their bets. And so they start to buy gold, they start to buy Bitcoin, they start to buy silver, they start to sell all their treasury bonds. And I would argue that the recent moves in gold and silver are kind of indicative of that story, of what's happening, of the sort of faltering economic growth story fundamentally, and the sort of shift of institutional capital and of personal capital into hard assets.
Which is ironic because, Warren Buffett always calls gold a pet rock, but the function that it's fulfilling is no different once you have gutted that economy of the GDP growth, once there is no quote unquote value for that associated with that GDP, right? You do want to really protect that purchasing power more than anything. And that's why that demand is being driven into quote unquote hard assets. There was one other thing, that I wanted to chat with you, Roberto, about was in your silver interview, you spoke about silver being added to the list of US, not necessarily precious metals, but it's
critical minerals. Yeah.
Critical minerals. Yeah. So why don't you walk us through, that whole, how that's played out, and also how you view that in specifically what Infra was talking about earlier regarding hollowing out of the US industrial base, and how we would potentially have to bring some of that back in order to generate real GDP at the end of the day, right?
Sure, absolutely. I think, our story really goes back to 2014 in China, when China opened the Shanghai International Gold Exchange. And this exchange was the world's first large-scale, physically settled precious metals exchange, where they trade, gold, silver, platinum, palladium, copper, and all contracts are settled physically, in contrast to the COMEX and the LBMA, where something like 99% or more of contracts are settled via cash transfer, right? And that exchange kind of flew under the radar for many, many years, right? There wasn't much volume. Fundamentally, the Chinese growth story was still pretty strong, at least in the mid-2010s. But as we get to the late 2010s, and then obviously COVID-19, a massive property bubble had formed in China. And the key to understanding China is that China is a completely different economy than than the US. Obviously, not only are they communist, but they're also in this like kind of quasi state branded capitalism that allows them to have a free market, but only within certain bounds. And so as an individual or as an investor, you can invest in a company, you can buy this stock, you can buy that stock, but it's all under the understanding that if the CCP comes knocking at your door and tells you that you have to sell, or that tells you that you have to divest, or you have to move your funds or move your capital, or force the CEO in order to do something in alignment with the CCP, that you will do so. And so it's not really a free market in that sense. And because of that, the Chinese equity market, and also because of obviously their capital controls and their kind of crony capitalism and corruption that goes on in China, their equity market has essentially gone nowhere for the last 10 years. Like we're actually, even now, we're below their 2008 high in the CSE, in the China's Shanghai Composite Index. And real estate was really the savings vehicle for Chinese investors. So from 2010 to 2020, around 70% of all excess savings were funneled into real estate investments. And one of the main, I guess you could say, like metrics of societal status or societal wealth was that you owned an apartment or owned a house. And that basically, that combined with some regulations made by China, allowed them to blow up this massive property bubble and basically destroy any sort of fundamental growth in that sector, because all of these investors had flooded in, and all of the developers had started to pre-sell units and pre-sell houses, and allow people to essentially buy future contracts or future construction projects at a discount in order to get what they would call cheap financing for these projects. The problem is the developers obviously got overextended on this, and the most famous being Evergrande, which was a $300 billion giant, I think the second or third largest property developer in the world. Country Garden also blew up, which was the first largest in China, and maybe I think second largest in the world. And the explosion of those two property giants in 2023 sent ripples throughout the economy. And we've seen major real estate prices in cities like Shanghai or Guangdong fall like 20-25%. And even worse if you're talking about the very, very high-end industrial real estate areas. And so the Chinese investors have basically seen their investments fall massively in value. They've seen a property sector that's overextended. They've seen massive bailouts, essentially what I would call stealth bailouts from the PBOC. And so they've kind of responded in kind. They're like, well, I can't buy stocks because that market's corrupt, and real estate is now, a bubble that's slowly imploding, and it's going to require probably in excess of $2 to $3 trillion of stimulus in order to rescue. So gold is the answer, right? Gold is like the safe haven. And given that capital can't really freely flow out of China, it's really the only investment that they can make. And so starting in 2023, there's a price differential started to open up between the Shanghai Exchange and the American COMEX and the British LBMA. And at first it was very small. It was like $1 or $2 an ounce. I started to see accounts like Oriental Ghost on Twitter start to follow it. But by 2024, especially the gold premium started to rise to around 60, 70, even $80 an ounce at the highs in 2024. And that's why I wrote one of my viral threads called The Gold Endgame Begins, where I described how this higher price in China could eventually lead to much higher prices in the US, because now you have a physically settled exchange that is trading at a significant market premium to the COMEX or the LBMA. So traders can go to COMEX or LBMA, they can buy a futures contract at a discount to what they could get it for in Shanghai. Then they go to Shanghai, they take delivery of the metal, they ship it to Shanghai, and they can sell it for the premium and pocket the difference. And obviously this differential, when it's small, the amount of trading going on in this market would be small, right? The transfers from west to east would be pretty negligible. But as the premium has increased, that has meant that the overall trading volume on both exchanges has increased, because more and more traders are able to take advantage of this arbitrage trade. And so that has been pulling gold and silver up massively. And I think the US has started to realize that China is starting to you could call it, militarize or weaponize silver and gold in this fashion. And that's why they've responded in kind now in November of 2025 with their announcement to add critical to the silver or add silver to the critical minerals list.
And sorry, the COMEX gap that existed was specifically for gold that developed over from 23 to 2025, right? Is that accurate?
Yes, it was first in gold, but the Shanghai premium also developed in silver in early 2025. So it started first in gold in mid 2023, and it eventually transferred to silver later on. Yeah.
So I guess the question that I had was, if they were allowed to purchase gold, like let's say there was a strong bid from the Chinese market from 2023, why are we only recently seen gold prices spike into kind of that parabolic rise from, let's say, 3K gold to 5K gold, or 2.5K gold to 5K gold?
So I would say, first off, gold is a huge market. So even with large capital flows, it takes a long time for the movements to be reflected in the price. But I would say, like, the move from, let's say, October to January was less of a fundamental, just bullish move and more of like a short squeeze. If you look at net bullion bank positioning in October of 2025, it flipped from net short to net long for the first time in history. You saw hedge funds and CTAs taking long positions, and the shorts that remained were essentially trapped because many of them had built up these large paper short positions over years, and with the price rising inexorably higher, they started to have to cover. And so that move in silver that you saw in January and that move in gold, I think that was less of, oh my God, China's collapsing and just this month they're deciding to buy everything and it's a frenzy. Yes, there is obviously strong retail demand in China, and there is some strong retail demand in the US, but the vast majority of that move I would attribute to a form of short squeeze on the market.
Gotcha. So I guess in your, and I'd like to get Infra's view on this as well. In your view, there's no net change in that buyer behavior, and silver and gold continue to flatline, potentially break to the upside again. I mean, is there another risk of a short squeeze? We've seen a bunch of markets blow up in the last 2 to 3 years. Even copper, some of the copper, stocks have been ripping recently as well. So all the precious metals seem to have that fundamental risk there. But I mean, this doesn't feel like a collapse in silver and gold.
Yeah, no, I don't think it is. I think long term, I'm bullish silver and gold. I think both of them are going to grind higher. Now, these spikes higher are because of this, short dynamic that we've talked about, but also because just of the amount of massive paper leverage that exists in the West. So I talked about this on one of my recent Substack pieces, but the average trading day of COMEX in 2025 saw around 104,000 contracts trade, and that's according to their own data. Now, for silver, each contract represents 5,000 ounces. So that means the average daily trading volume was 500 million paper ounces of silver. Now, global silver production is 2.2 to 2.3 million ounces a day. So that means that the paper trading on each day on the COMEX outweighed the total daily global silver production by 220 times. Now, that kind of dynamic is just an example of how insanely levered, the market is. The LBMA is similar. It's like 200 to 300 times X paper contracts to actual physical metal. And so it doesn't take much to actually, push this market to the breaking point and cause a short cover, or, you could call it like a bank run in the form of rush to bullion. We saw that in January and February of 2025, actually, because the LBMA started to have, huge bullion withdrawals and strains on their actual operations and seeing delays in deliveries. We saw people flying gold between London and the US and New York in order to hedge the difference, even between London and the US and COMEX. But overall, you have to remember, right? Like, both gold and silver are not only, I would say, monetary metals, but especially silver is mainly an industrial metal. It's the most electrically conductive element on the periodic table. It's used in all sorts of consumer electronics. It's used in solar panels. And China right now controls 70% of global refining capacity. They hold about 85% of global solar manufacturing capacity, 98% of wafers, 90% of cell production, of solar cell production, and they also produce the largest amount of silver in the world. And starting January 1st, they announced new export restrictions that basically make it more difficult for small and mid-sized firms to export silver. So some people called it an outright ban. It's not an outright ban. Large companies can still export silver outside of China, but it just makes it much, much harder. And I wouldn't be surprised if China continues to weaponize silver as we go forward into this multipolar world and kind of break off from our previous American century of complete hegemony and dominance. I think the deglobalization trend is going to continue.
Yeah, and it just sounds like the whole chip shortage all over again, where something happens and then the US turns around and says, actually, we're highly reliant on X, Y, or Z. It's amazing how short-sighted a lot of this is because of such strong globalization tailwinds that we've had for the last 20, 30 years.
Mm-hmm. Yeah, exactly.
But Robert, I know you've been bringing up some charts in the background.
Yes. Well, so here's the 10-year yield minus inflation. That's that real rate that was deeply negative after World War II that we were talking about with financial oppression. That used to be have a very, very strong correlation to the rate of change of gold, the gold price. So in red, what we're looking at is the 12-month rate of change of the gold price. So, at any point in time, over the preceding 12 months, what percentage gain up or down had gold made in dollar terms. And the correlation used to be very, very strong, or, going back all the way to the 1960s. However, something changed here around 2021, 2022. We seized the Russian FX reserves back in 2022. So, a lot of people trying to make political points or partisan talking points about the de-dollarization trend. It started sooner. It started in the last administration. And we're, it took 50 years to build up that kind of flywheel, the dollar flywheel. And it's going to take a long time to unwind. And look, the dollar's not going to be, worthless overnight. We're not going to wake up and nothing's in dollars anymore. And it's, wheelbarrows of cash. In my opinion, I don't think that that's how it's going to play out. I think it's going to play out around the margin. If you look at foreign held debt as a share of total government debt, so the relative rate of change of total government debt and foreign held debt. Sure, if you look just on a nominal basis, foreign held debt, U.S. Treasury debt held by foreigners, that it's going up. But you have to look at the rate of change. How fast is it growing up? If we're growing our debt by 20% a year, we're not, but just easy math, and foreigners are growing their holdings at 5%, well, that's not they're on a net basis. They're not really actually buying any more debt. In fact, they're downsizing relative to our debt issuance. They're actually downsizing, in terms of relative share. So I think that, you look at that peaked during QE3 in 2013. You look at dollar share of FX reserves, that peaked, and has been in decline for over a decade. So these kind of things, they take a long time to play out. They took a long time to build. And it's going to take a long time to kind of unwind. And I think gold and silver are just kind of the first part of that. Coming out of the Great Depression, it was mandated that I think it was 40% of dollars be backed by gold. Well, if you transfer that out to today, that would require about a $30,000 per ounce gold price. If you look at foreign held debt as a share of the value of gold held by the U.S., it would similarly require about a $29,000 gold price, just to kind of go back to the historical norm, right? Foreign held debt, as what backing of the foreign held debt do we have in gold? To get back to a historical average takes a much, much, much higher gold price there as well. I find it interesting that both of those points converge at about a $30,000 per ounce gold price. We're going to see a lot of volatility. There's that chart of the gold price in Weimar currency units, right, during the hyperinflation. I don't think, we're going into a hyperinflation, but I do think that there's going to be, an increasing amount of volatility. We had this kind of a low volatility environment for the past 50 years. And especially since 2008, I think that trend is no longer. And I think globalization, I think I agree with Roberto. We clearly reached peak globalization, and the pendulum's going to start swinging the other direction. I mean, if you look at the yuan, like no one's talking about this, but they're letting the yuan strengthen, actually, like somewhat significantly. And it just broke to another 3-year, the dollar broke to a 3-year low versus the yuan. They've been trying to internationalize their currency. They've been trying to stimulate domestic demand, just as we have been trying to kind of reindustrialize. And we realized, oh, wow, you actually need like mining capacity, silly things like being able to, create, have real tangible commodities. Just as we're realizing that here, we need to be able to manufacture missile components on our own and not rely on our enemy to do it. Those sort of things are happening in the US, but in China, there are comments going back 5, 6, 7, 8 years of top CCP officials recognizing that their economic model of this kind of subsidized, overcapacity export dumping kind of approach, it was getting to an extreme as well. And that they needed to, basically we need to meet in the middle. The US needs more industrial capacity and China needs to stimulate domestic consumption. And I think there's an opportunity, kind of that Mar-a-Lago Accord stuff I've been talking about for a while. I think there's an opportunity for some major kind of reordering in the global monetary order. I think gold is signaling that. And look, even if we don't get a Mar-a-Lago Accord, even if we don't have Plaza Accord 2.0, this official currency revaluation kind of conference, even if we don't, just the fact that gold is rising as a share of global FX holdings, reserve holdings, just that on its own, gold will rebalance trade, right? This is how it worked before the dollar, before the kind of modern system, was if you ran a huge trade surplus, well, on a net basis, a current account surplus, gold was flowing into your country. Well, gold was money. So money flowing into your country, wealth, liquidity, stimulus, right? GDP, inflation. And so the central bank would have to hike rates to control inflation. That would make the currency appreciate until eventually you couldn't run such a large trade surplus because your currency was overvalued. Gold starts to flow out of your country and the exact opposite. It was this kind of ever fluctuating equilibrium that was found back before this, just buy the dollar. It's the reserve currency. You have to own it to transact in commodities like oil, petrodollar. Before that, you didn't have 5% of GDP current account deficits prolonged or surplus, right? You look at China, Japan, just as we run a 5% current account deficit, they run 5% of GDP current account surplus. So there's some really, really large imbalances that have kind of built up structurally that need to get unwound. It's not going to happen overnight, but I think that things like gold, I think like things like the yuan, I think that there's signals there if you're paying attention.
Yeah, I guess what does that mean for China's currency at the moment then? Because are we saying that there's a bulk of gold moving into China, and how does that affect its currency and its inflation?
Yeah, so like the way that this could kind of rebalance, just in my view, is, say we run $1 trillion current account deficit with China. What that means is we're sending $1 trillion per year of dollars out to them. Well, if they're de-dollarizing, and they are clearly, objectively, it's a fact. If they're de-dollarizing, we send them dollars, but they don't want dollars. They sell the dollar to buy gold. Well, what does that do? It pushes up the price of gold in dollar terms. Eventually, there is no country that China runs a trade deficit against, right? There's no country that's trying to de-yuanify, that has $1 trillion yuan, like, oh my God, we don't know what to do with this. We're trying to de-yuanify. There is no country, right? They run a huge surplus with everyone. So what you end up getting is, the price of gold in dollar terms is going to appreciate at a faster rate, provided they don't like print yuan for gold or anything. The trade imbalances and the capital flows, they will eventually, the price of gold will get so bid up in dollar terms, that gold essentially acts as a pivot point to revalue currencies, because then arbitrage opportunities develop. Obviously, if you look at dollar yuan exchange rate relative to gold price in dollars, gold price in yuan, there would be an arbitrage there if it wasn't that gap wasn't closed. So what you effectively do is set a new exchange rate where the dollar's weaker, the yuan is stronger.
And China's been encouraging that, right? If you look at not only their official statements from the PBOC about their gold purchases, but I've done a couple gold research reports, both for my own Substack and my YouTube, but also for institutions like Incrementum. But China has been essentially adopting this, I guess you call it like a stealth gold accumulation strategy for the last 5 or 10 years, but it's really accelerated since COVID. Although they only are purported to have 2,200 tons of gold in their central bank holdings, because of data from the World Gold Council showing a huge amount of gold purchases happening every single quarter that are unaccounted for, but are happening from some large entity, we can assume that roughly 70 to 80% of those purchases are China, buying through Chinese hedge funds, national wealth funds, foreign banks. And what it implies, Yan Nguyen Wenhouse at the Gold Observer has a whole report about this where he breaks down the numbers. But what he implies is that the actual gold holdings of the PBOC are more like 5,000 tons, which puts them ahead of all Western central banks, not just the US, but all of them combined in total gold holdings. And the Chinese retail sector is seeing a similar story. The Chinese official, like the Chinese government, the CCP, has actually been encouraging gold holdings. Starting in 2025, they allowed gold to be used as collateral at a couple of the large prime banks in China. So meaning you can, let's say you own 5 ounces of gold, 10 ounces of gold, you can go deposit it as safety deposit box. It gets insured by the state national insurance agency, and then you can take collateral loans at it, off of it, at the market rate. And so that allows you to use gold as almost like a form of credit, right? Like a HELOC on your house, without actually having to sell the gold. And so there's increasing moves like that to financialize gold and to integrate it more deeply within the Chinese financial system. That's not happening in the West. And all of this is also to, not even state the fact that China's one of the largest gold producers in the world. And by and large, they don't export gold. They only import it. And same with silver. And so that by the virtue of the fact that what Robert said, they're net exporters and they have a positive current account surplus with everybody, but also that they're gold and silver importers. Essentially, they're kind of like the first mover in this chess game of de-dollarization and goldification, as you could say, of their foreign exchange reserves. And I'll also say this as a closing point on this. A lot of people have opined about the death of the dollar and the collapse of the dollar system for decades, right? And largely those people have been what feels to be wrong. And so that's made them seem like they completely don't understand the system. And the problem is they do understand the system, but they have some fundamental misunderstandings about how, currency dynamics, reserve repos, central bank, foreign exchange reserves, how that actually works. Getting rid of the dollar as a reserve currency is extremely difficult, as put forth by Brent Johnson of Santiago Capital in his dollar milkshake theory, right? You actually do need dollars to conduct trade. Now, the problem is for the last 40, 50 years, buying dollars equated to also buying treasuries because treasuries were positive yielding debt. And so China, Japan, right, Europe, Canada, basically all of the globe was buying U.S. treasuries with any excess dollar reserves that they had. And, for example, from 2005 to 2010, during the great financial crisis, the U.S. issued, $5 or $6 trillion of additional debt to deal with the fallout of the 2008 financial crisis. And China and Japan and a couple other foreign holders financed about 75% of that. And fast forward to the late 2010s, 2015 to 2020, China and Japan and the rest of the world was only financing on net 14% of the new issuance. And so that shows that delta, although their holdings, like Robert said, are nominally increasing, as a percent of total treasury holdings, they're not. And so that shows that their treasury purchases are slowing. And why this is dangerous is because this is actually how a reserve currency dynamic falls apart. This is actually how a reserve currency dies. It doesn't happen with, one day China says, we're not using the dollar, and the dollar collapses 80% on Forex markets, and hyperinflation starts the next day. What it starts with is the divestment, especially on the long end, of U.S. Treasury bonds. So the 30-year bond, the 20-year bond, then the 10-year. And as the crisis gets worse, as this, you could say, like American Dutch disease continues, we could see more and more selling and divestment from the long end, and have that divestment move closer and closer to the ultra short end. And then eventually, obviously, just basically have every other nation just be stuck in T-bills or simply cash. And that's very negative for the U.S., right? Like we mentioned, the U.S. is already running a 7% deficit to GDP. We have 23% of our interest payments, or of our total fiscal outlays as interest payments. We have $38 trillion of total debt. We're paying over $1 trillion here in interest, and it's only going to rise as total fiscal spending continues to accelerate, as baby boomers retire, as more and more defense and critical industries need to be financed, as we rebuild the United States, as AI, for example, like we mentioned earlier, takes away potential fiscal revenue for the U.S. government, because it basically implies that a lot of high-paid white-collar workers are not going to be employed, and therefore they're not going to be paying Social Security or income tax, which is a major part of the U.S. government's revenue. So all that in conjunction is to say that China is essentially doing this, like you could say, 10, 20-year chess endgame of slowly divesting from the dollar, but not in a way that would immediately cause a dollar crisis, but is rather causing, I would say, like a fiscal crisis.
Well, hopefully they catch on to the fact that Bitcoin's way easier to buy and manipulate than gold, because the market cap is way smaller compared to the global market cap of gold. But we will leave it there. Roberto, thanks so much for hopping on. Really appreciate your insights. We should do this again soon, maybe like once every couple months. Infra as well, really appreciate it. Guys, we're going to call it there because we have another show in about 5 minutes' time. Thank you so much, everyone for joining. We will see you in 5 minutes. Have a good one.
Awesome. Thank you.
See you guys.